Hello, and welcome back to our podcast series, Collections Conversations, sponsored by our friends at C&R Software. Today's episode is about financial health, which I'll admit isn't a topic that on the surface seems super complementary to collections. However, if you dig in just a little bit more, I think you'll see that the two topics are in fact deeply complementary. No one understands this better than my guest for today's episode, Rochelle, founder and CEO of SpringFour. Founded in 2005, SpringFour empowers businesses to connect their customers with vetted local nonprofit and government financial health resources, everything from food assistance to financial counseling. SpringFour was acquired by C&R Software in 2024, and it was, I kid you not, one of my all-time favorite fintech acquisitions. Why? Well, it's because both companies are in the business of delivering better outcomes. After all, collections at its most fundamental is about improving outcomes. It's about helping vulnerable customers get back on track financially and then keeping them there. Now, viewed through this lens, this makes all the sense in the world to think of collections as one of the most important avenues for focusing on financial health. In this episode, Rochelle and I talk about how lenders are beginning to operationalize financial health as a collection strategy and the results that such a strategy can and in fact are delivering for leading lenders. It's a conversation that I've been wanting to have for a long time, and it was unsurprisingly a delight. So without further ado, here is episode 5 of Collections Conversations. Okay, Rochelle, thank you so much for joining me.
Thanks for having me today.
I am delighted to have you. You and I think, have had versions of this conversation offline probably many times over the years.
Yes.
And so I'm looking forward to doing this in the form of a podcast for a bunch of reasons, not the least of which is that you and I think, and this predates SpringFour being acquired by C&R Software. You and I have been very aligned, I think, in our thinking on the ecosystem and kind of what's missing and sort of how lending and credit and collections needs to evolve along the lines of what we're going to be talking about. So I'm very excited to dig into this conversation. And I wanted to start with a somewhat kind of broad question, but I think it's a useful place to start, which is, in previous conversations that we've had, you've pointed out to me that collections often ignores the why behind delinquency. And I was curious if you could sort of elaborate on that and talk about like the moment you realized that lenders needed a way to think about the root causes of a missed payment, not just the missed payment itself.
Right. Well, thanks for asking that question, because that is something that has led the journey at SpringFour since day one. And we do believe that it is so important to understand the why behind a person's missed payment or financial hardship. And if you can address the root causes, you're going to be able to help that person get back on track with their payment. So I suppose the $1 million question is, why do not more lenders and servicers and collectors focus in on the why? And I think it really comes down to the fact that, you know, it's harder in some ways to address the why in your conversation with a person who's behind on their payment than just say, hey, you know, you're behind, where's my money?
Sure.
But the thing is, if you put time and effort into figuring out and training your teams on how to address the why, you're going to have so much more significant results. So the reason that I was focused in on the why was because of my history of working in community development, in lending, putting together partnerships between banks and nonprofits, and working with housing counselors who were trying to solve the big mortgage delinquency problems of, you know, the 2000s. And the thing about it is that so many families were losing their homes to foreclosure and they didn't know where to turn for help. But if we could help connect people to local nonprofit and government resources that could address why they were missing their payment, we knew we could get them back on track. And so that's what we've been focused in on for 20 plus years now, and it's working. We have amazing, significant results. And so, you know, it's really important to understand that if you can connect people with resources that help reduce their household expenses, it's going to create that cash flow that allows them to get back on track, because for the vast majority of Americans, no one wants to be behind on their bills. No one wants to be behind on their mortgage, their auto, their credit card. It causes a lot of stress. And so we're looking to alleviate that.
That makes a lot of sense. And just to add to your point, in addition, I think to consumers not wanting to be behind on those obligations, right? To your point, like, I'm not missing this because I just decided not to pay it. I'm not missing it because, like, there's always a small percentage of like first party fraudsters who like
Sure.
that's fraud. That's a different thing. But like for customers that are like genuine customers, they're missing it because something has happened. I think the other thing that's worth just kind of pointing out explicitly is collections is not a place that lenders want to be. Foreclosure is not a place that lenders want to be. Repossession is not a place that lenders want to be, right? Like these are worst case scenarios for the lender as well. And so to your point, I think there actually is quite a bit of alignment in terms of goals by both the financial institution, the servicer, the collector, and the end customer. And yet at the same time, there is this sort of persistent mismatch, I would say, between a lot of lenders' like tactics for what they do when that moment hits versus sort of what would be most useful to the customer or what they're kind of looking for. So you referenced that obviously you guys have been working on this for more than 20 years, which is amazing. I'm curious, like, what you've seen change over that time. And maybe we can start specifically with customers and what you see sort of in the lives of customers and how that's changed over that time. Because I think in some ways, obviously, where you guys got your start was very much in the shadow of the financial crisis and working with, home lenders to try to keep people in their homes and avoid foreclosure. So obviously, like, there were some macro conditions that were very specific to that time. But like, just in general, how would you sort of characterize how the consumer has changed over that time?
That's a great question. I do believe that in some ways, in a lot of ways, not much has changed with the consumer. There's always going to be a large volume of consumers that are experiencing financial hardship and are behind on their bills. So that's a pretty constant in the industry, right? But you do see changes in the overall financial health of consumers. I believe it's gotten worse. So I just published on my LinkedIn the other day a B of A study that said that 94% of Americans are living paycheck to paycheck. So
I saw this, yeah.
Yeah. So when you're living paycheck to paycheck and something happens in your life, your car breaks down, you get laid off at your job, you're getting a divorce, you have a medical emergency, that is going to trip you up in being able to make your payments that month. And so I do think, the worsening of the overall consumer financial health, we all believed in the financial health space that we were making progress and we were seeing an improvement in people's overall financial health. But I do believe it's deteriorated. And there is a lot of, other macro things occurring right now. So high costs, the job rate, the unemployment rate, lots of different things going on in our country right now that makes consumers' financial health very vulnerable.
Yeah, absolutely. So let's talk about solutions and how to help address this. Because as you said, despite all of those challenges, you're seeing progress in terms of lenders being able to help, customers who are in these situations. Let's start here from sort of an experience perspective, and then we'll kind of get into the mechanics of how it works. So from a customer experience perspective, when a customer first falls behind, what's the single most important thing that a lender can do in the first conversation or first couple of conversations to sort of signal that they're there to genuinely help the customer rather than just to collect on the money that they owe them?
Number one, convey that they are there to help, that they do provide assistance, that they want to provide assistance, and make it easy for that customer to access it and to really take the stigma away from having a payment hardship. So the first step that we like to see is that we really encourage the industry and our clients to adopt digital strategies to make that message heard or, present and visible to your customers. So it's great when an institution has a financial health, a dedicated spot within their website to communicate that there are lots of different information and resources and steps that people can take to address their overall financial health. Then when a person calls in or they're receiving a call from a collector, they can be pointed to that. And I think it really helps encourage trust from the consumer that the institution does want to help them. Number one, people are very afraid, and there's so much stigma associated to being behind on their bills that they don't really believe that their lender and servicer wants to help them. And probably if they've been behind in their, ever before in their life, they have gotten collection calls that haven't been very pleasant, that haven't been very nice, and that haven't extended the olive branch, if you will, to try and help them. So I think there's a lot of different ways that organizations can convey that to their customers.
Well, it's interesting because one of the things that's come up in some of the previous conversations that we've had as a part of this series is the idea that you can have sort of a product or debt sort of mindset as a lender or a collector, or you can have a customer sort of centric mindset to working with them. And like if you have a customer centric view or a relationship centric view, I think, and correct me if I'm wrong, but like you've seen a lot of this best practice kind of play out, so you would know better than I would. Like it starts with, obviously, as you said, conveying we're here to help. I think it also starts with like trying to understand the root of like what's happening, and not like one of the things I'm constantly annoyed by when I see sort of collections done badly is sort of saying like, hey, as long as I can get you to give me a promise to pay me this specific money that you owe me, that is the extent to my interest or curiosity about your life and what's happening, right? Like it's not my problem if you have other debts that you might owe and you're trying to figure out what order in which to pay them back. It's not my problem if you, in promising to pay this amount, which is the full amount you owe me, you are jeopardizing these other things that are also important in your sort of personal financial stack that you have to manage. Like the level of sort of like lack of curiosity about like the broader situation that the consumer finds themselves in. I think partially that's why it's so transactional, right? It's like, I feel like when it starts on that transactional level, it immediately conveys to the customer, oh, this person's just trying to check a box, get to what they need, and then get off the phone. Like, this is not a conversation where I can tell them anything. Totally. Right. Yeah, that's their goal.
And they have competing interests, right? Because they have to get through their calls, and they're evaluated on how long they're spending on those calls and what the outcome of those calls are. So it's really a system that's not set up for really for the success of getting that customer back on track and then retaining that customer. So, we have to really flip it on its head and look at how can we do collections and servicing different? And how do we understand that by doing that and investing in that, really that sea change, right, in collections and strategy is going to absolutely produce significant results for that lender. But, everybody is, well, I shouldn't say everybody, but it seems to be that, everyone is focused on really not looking at the problem long-term and making those necessary changes. And it's going to take a little bit of time before you get those results.
Yeah, well, I think that's a good point too, right? Because this is one of those ones where the results will show over time, but you do have to kind of accept that like, in the short term, in between, you might actually see a reduction in some of the metrics that you've trained yourself and your team to care about, right? Like longer calls, maybe
and we have seen that.
I was
sorry to interrupt you.
No, I was going to ask you that. Yeah.
We've seen that, and we say like that. it's going to be worth it. We promise you. And then we've actually seen where the calls go back to being just as efficient as they were, as people and collection agents learn to use the tool and understand how to do it and listen for cues. But there's definitely a payoff to doing that. And in the short term, yes, but that's why we need the, buy-in from executive leadership to say, okay, we're going to do this. We're going to do it differently. We're going to see some of our metrics change, but we believe that the results will far greater outweigh, the disincentives of increasing call times at the beginning.
Right. We have a conviction about why we're doing this that will sort of see us through some of those choppy metrics in the short term. So I guess, can you sort of describe a little more mechanically what collectors can do differently to help customers who find themselves in these situations? Because I think, the other thing that comes up a lot is obviously, like, customers don't always know, like, what options are available to them. And I think the range of options, like I sometimes describe it as the tools in the toolbox. Like, there's a lot of tools in the toolbox for customers that find themselves in this situation. And so I would imagine that part of the goal is to just, first of all, like, take a breath. Like, we're here to help you. We want to understand what's happening, and we want to give you as many options as possible. Two, we want you to, like, understand the scope of options that are available. And then three, like, here's the right path for you specifically. And I'm curious if you can kind of elaborate and sort of paint a picture of, when you think about good and, like, what good best practices look like using that full scope of tools, can you kind of describe how that works?
Yes, sure. So I think number one is, when somebody is experiencing hardship, you're absolutely right. A lot of times they don't know what's available to them. They don't know who to trust. They don't know where to turn. And that's really the power of an organization working with, SpringFour or another organization to connect their borrowers to what we offer, because we curate and research and vet all of the organizations. We understand. I came from the banking industry. I understand that banks are very risk adverse, and they really want to ensure that their reputation stays, very positive. And so we need to make certain that if we're making referrals, that those referrals are made to organizations that have the track record, the capacity, the funding, and also making sure that people don't turn to unscrupulous actors. So that was one of the main reasons that we created SpringFour, because in the 2000s, I'm sure it's, very prevalent as well today, but it was about making those connections to the helpers in a person's community, making sure that they weren't going to get further behind, or someone was going to trick them into signing over, the deed to their mortgage. So it's really important that people understand that these are trusted resources. So only nonprofits, only government organizations. I always tell people, look, if somebody's reaching out to you or they're a for-profit company, they probably don't have your best interests in mind. So that's a value add that we offer to our clients. We're making sure that they have that dependable data that they can make referrals to. But also, that's why it's important to make certain that customers have a self-service tool as well, because as a collector, you may or may not always be getting the full story, right? As I mentioned before, tons of stigma around hardship. And so people are vulnerable and they're afraid, and they may give you a little bit of information as to why they might be behind, but probably not the whole story. So creating an environment where they can, in the safety of their own home or on their phone, look for resources and they don't even have to tell you, is goes a long way to helping people feel more comfortable about then, calling you back or getting further into depth with you as an agent trying to assist them.
So just on that note, so what you're saying is it might actually be a scenario where the call happens later, or at least the longer conversation happens later. And it might be like exposing people to options and tools and resources. And here's kind of like what's available to you. Take some time to research, think about it, look at these different things. And then they might come back to you later and go, okay, now maybe I have a plan, or at least some thoughts on kind of directionally what I would like to do and how I can work with you. Is that kind of
Yeah,
common?
absolutely. And then what we, as a best practice, we love to see lenders and servicers include the availability of that information and help a link to the
Mm,
digital solution within payment notifications, within
sure.
SMS texting,
Hmm.
late pay notifications. So, why not include the mention that you have this available consumer portal to
Hmm.
assist and help?
Hmm. So let's get specific because I think a lot of folks listening maybe don't know the scope of what's available. Can you give us some specific examples of the types of resources, government or nonprofit, that can help, and like specifically why those types of resources are helpful to someone who finds themselves in this situation?
Yeah. So I think the biggest thing is to have a one stop shop, right? So
Hmm.
customers who are behind on their bills for a certain reason, there's probably, as I mentioned, a lot of other things going in their lives that
Yeah.
is causing shortfall and inability to pay. And so, what we want to do is make certain that people can access as many resources in as many categories as possible. So, we have built a powerful, database of over 30 different what we call spending categories. So, if you really think about a person's household budget, we're trying to identify resources that could help reduce the costs in each of those areas. So anything from food assistance and food savings to heating and utility assistance, home repair programs, help with property taxes, help with healthcare costs. So you mentioned earlier, how has the needs of consumers changed? That's one really big shift, right? So when we started this, most of us had really good healthcare and we paid, pretty little for that healthcare. Now
Yeah.
we're seeing, and with recent changes, just healthcare costs skyrocketing. So that's something that can really trip people up. So we're finding and locating community healthcare resources and programs that can help reduce those costs, as help reducing prescription drug costs. We have employment resources and job training resources, transportation resources. We have help for student loans. So I could go on and on, but lots of different resources, and it's really important to have all of those resources available. And we find our data shows that on average, people usually receive anywhere from 4 to 6 referrals. Resource categories,
Hmm.
because their needs are complex and multifaceted.
Yeah, no, that makes sense, right? And I guess to that note, do you see where certain categories kind of map to different problems, right? Because, like, to your point, a lot of what you describe, and this goes back to the earlier conversation about what's changed and like what's kind of made consumers' financial lives more challenging. Like, a lot of them are just like cost of living type stuff, right? Like, this is very expensive. There might have been something that happened in my financial life, whether it's a medical event or losing my job or what have you, that's made it more difficult for me to just be able to afford these things. I also am curious about, maybe we could double click in a little bit on the financial counseling and employment components, because I don't think we think about this enough in financial services, but it's like the trajectory of our customers' financial lives, which are determined by the economic opportunities that are available to them, the financial decision making that they, kind of employ, like all of those things determine. And I'm speaking in a very selfish language, but I think sometimes you need to when you're talking to, bank executives who are kind of trying to make the dollars and cents make sense. Like, that can also change the trajectory of how like good a customer this is, how profitable a customer this is to
Exactly.
work with over time. So can you talk about, I guess, like maybe the distinction between bridging short-term cash flow gaps to get back on track, which is like super important, especially for these like acute moments of stress, and then like longer term changes to a customer's trajectory and kind of how you see those two things fitting together?
Yeah, they fit in really well. So I think of, if I was a bank or
Mm,
servicer, I would want to be there for my customer in all
yeah.
the times,
Yeah.
good and bad. And so we have seen clients who really get it and really understand that what we're doing can be um, a stepping stone to further uptake in products by an institution, right? So you're encouraging you're increasing your borrower trust, your borrower engagement, you're showing them the way, and you're destigmatizing it, and you're making it available in a safe and friendly way, so that people can access resources. So, for instance, if you are declining somebody for a loan, that's not something that you want to do. But what happens if you then share that message with a message of hope and a message of, here are some tips and here are some tools that could help you, so that, if you do these things and you look for ways to, decrease your expenses, you're going to increase your, debt to income ratio, and you're going to be able to qualify for the loan the next time, or in like 6 to 9 months. That's really going to endear that person to your brand, to your company, to your loan products, and they will come back to you. And we've seen that happen. We've also seen SpringFour presented in onboarding, so that, hoping to prevent any future delinquencies or hardships, and knowing that they can turn to the bank for assistance. But I think that it's super important to really destigmatize this whole issue of financial health or payment hardships or assistance. It's mind-boggling to me that so many institutions, we can't talk about their delinquencies, we can't talk about their strategies. I mean, we have clients that use us that really don't want to talk about it in the public sphere. And I am just baffled by that, because to me, it tells the world that you care about your customers and you're doing things to assist them. And I think we've got to get away from this idea that, look, every institution is going to have delinquencies, and it doesn't mean you did something wrong. It doesn't mean the consumer did something wrong. It doesn't mean that your lending decision was wrong. What it probably means is that life happened. And so why are we not really hyper-focused on making sure we're there for the customer when that does happen? Because I will tell you, it's going to happen at some point.
This episode is brought to you by CNR Software. More than just debt collection, CNR sets the global standard for AI-native humanized credit management. They simplify the complex with technology, built for modern financial services, delivering end-to-end credit risk lifecycle support powered by automated workflows, AI-native intelligence, and real-time data-driven decisioning. Learn more at crsoftware.com. Well, so you touched on an idea there that I think is worth calling out and sort of emphasizing. The stigmatization exists on the consumer side and the lender side. And I don't think we talk about that as much as maybe we should, but it's like, to your point, this idea that lenders have where, and maybe it's because they don't want like investors in the market to think of them a certain way. Maybe it's that they don't want to like sometimes people are so weird and almost superstitious about like, well, we don't want to jinx it by like telling someone that if they have a problem in the origination or underwriting phase, that there are resources they can rely on. Like, that's such a silly, almost superstitious way of thinking. But I do think it kind of lends itself to this idea that like, oh no, our underwriting is perfect and 0% of our customers will ever have a problem. Like, no, wrong. You are underwriting people in a dynamic environment where, people are taking on credit, they're taking on debt for different reasons in different circumstances. And then those circumstances change and things change. Right. And we should expect that, like, to your point, life will happen. And the question is, like, what do we do when that happens and how do we adjust? So maybe to double click into some of the examples you were giving, another thing that frustrates me, and this has come up in earlier conversations we've had in this series as well, is I'm enormously frustrated when brands, when lenders, when banks sort of confine all of this to just the collections phase of the life cycle, where they're like, oh, okay, we're never going to tell you about any of these things. We're never going to evince any interest in potential challenges you might have with making your payments until it shows up as a delinquent payment. And it triggers this almost like change in like the attitude that a lender will have when they're engaging with the customer. It's like suddenly you're delinquent and now a set of processes will happen some of which might be kind of unpleasant for you, in order to correct this behavior. Whereas I think a more, not just a more humane, but like a more intelligent approach to it is to say, at every stage along the way, acquisition, origination, I think servicing, pre-collections is a huge opportunity for this. We should be helping people understand like how they're doing, how their payments are impacting their overall financial health. I'm a big fan of like integrating cash flow data into the whole user experience, so we can understand like a consumer's personal balance sheet and how it's fluctuating. So I'm curious if you can maybe illustrate with a couple examples where you've seen some folks sort of plug some of this in outside of just collections, maybe in servicing or other places, and what that can look like when you engage with customers earlier in this process.
So yes, I can. It's interesting, it's very exciting what we do at SpringFour. And one of the things that excites me most is that each of our clients does it a little bit differently.
Sure.
Of course, we have best practices, but everybody has their own spin on it. And it's really interesting. And, one client, they see amazing significant results. And what they're doing is they're emailing clients on a monthly basis, and they're looking at different segments of borrowers and emailing them about the availability of SpringFour. That's really all they're doing. And the results they're seeing are so significant. They see substantial increases in their net promoter score. They get unsolicited feedback and comments from their customers that, I always say like, wow, how much are these comments worth? Like the fact that customers are taking the time to write in to their provider to say how much they appreciated the assistance. They even get comments like, well, this wasn't for me, but I love that you're doing this. And then other customer sentiments around this really helped me. I was able to tap into, and they'll name the numerous resources, and it really, saved me. They're getting those results with sending out an email. So we all know that there's tons of emails and marketing being sent out. So, our team at SpringFour is really encouraging our clients, like, what you have the tool, you've made the investment in SpringFour, we're working with you. Now, what are you doing to let your customers know that it exists? Don't just keep it in delinquency. Don't keep it in collections, like move it up in the process and let people know that this is available for them. And when you do that, you're going to be blown away by the results. I can only imagine, we haven't been privy to them sharing how it has impacted, in this particular case, their repayment rates or reduction in delinquencies. But I know that it has to, from the data that we have seen. And we have other clients who have shared with us and measured the repayment results. From use of SpringFour. But getting back to like the different, data and use cases and all of that, we have a data portal that our subscribers utilize to look at their data and can see the differences in resource categories and kind of what pairs with what. And it's pretty amazing, the data that you can see and the ability to tie it to a unique identifier, because we don't collect PII. So we don't have access to our clients, customer data or loan data. But there is a way we can tie a unique identifier where they can track over time increases in repayment rates or decreases in delinquency. I don't know if I answered your question. I think I went off script.
No. It was great, because the other thing I wanted to maybe drill into just a little bit more on the point you made is just this idea that like presenting something earlier to someone gives them a tool to solve a problem that like delinquency is the result of a problem, not the problem, right? And I mean, this is a subtle distinction, but I think it's important. Like a delinquency is a problem for a lender. Like now we have a problem. But if you think about it from the customer's perspective, a delinquency is the outcome of a problem they were hoping to avoid, right?
Exactly.
And so it's a different mindset, but it's like if you present these resources to someone earlier, even in a totally self-service, digital, hands-off, like just FYI, this exists. If you need it, here's how you can use this. Like there's probably, this happens a lot where it's like they access this, they get access to resources, they do so proactively. And by doing so proactively, they are able to stay on track and not miss a payment. And so it never even really shows up in collections because of a thing that you did earlier to help a customer avoid the outcome of a problem that they really want to avoid in the first place. So I think it is worth just stating that like sometimes the way we define the problem and the timeline of the problem from like a bank or lender perspective might be very different than when the problem first shows up for the customer. And this, like, just think about the stress they feel of not having missed a payment, but knowing that within 3 months, if I don't change something that I'm doing right now, I am going to miss a payment. Like you can save them 3 months of heartache, stress, difficult financial decisions by helping get some resources earlier. So I think like to your point about this not always showing up in the data or not like necessarily being the way that you think about your operations, that doesn't mean it's like invalid or it doesn't make sense.
Right.
The other thing that I wanted to ask you about real quick is the agent side of it, right? So obviously there's a lot of self-service in collections now, but we still have call centers, we still have collection agents, we still have people working with customers in various stages of financial hardship. How have you found like these types of resources and this sort of different approach that we've been talking about to collections and helping people through financial hardship? How has it changed like agents' jobs and the way they interact with customers?
Oh, I love this question because this was something we did not set out to change or impact. And it's been such a fun impact to understand and see that we're having an impact on. So we do surveys of agents who use our tool every year, and the results are pretty amazing. So,
That's cool.
They report feeling more empowered. They're able to be more empathetic. They overwhelmingly say they enjoy their jobs more. So I wish I'm trying to figure out like how could we actually track the ROI of that, because I do believe there is a lot of retention issues with collection agents, right?
Yeah.
So collection agents who use SpringFour love it and they see a benefit to utilizing it. There's that human connection. They're able to actually connect with that person on the phone and deliver in a way some good news, right? That there are some resources out there, because without SpringFour, how are they answering that person's need?
Well, it's just fewer tools in the toolbox, right? I mean, I think that like, obviously there's some things you can do with like restructuring repayments and whatever payment plans, like there's tools in the toolbox, but the more tools you have, the more good news you can give to customers and be able to be helpful to them. The other thing, and purely curiosity on my part, but as you were talking about all these different resources, it also strikes me that like there's sort of a like local geographic element to this too that I think is really interesting, where it's like, I mean, a lot of financial services is digital these days, right? And whether you're working with a fintech company or you're working with a bank, like you might interact with them almost entirely digitally. Sometimes you'll call into the call center or talk to someone, but like branch visits are down. People don't go into branches as much. Lots of financial services brands don't even have branches or physical locations. And yet, and correct me if I'm getting this wrong, but I think a lot of the government and nonprofit resources that you connect folks to are local to some degree, right? That are like based in communities, that work in communities. Can you talk a little bit about how that sort of like community-oriented connection sort of plays into this? Because I would think that would be a very
it matters.
Like especially when someone is in a vulnerable state, the idea that like your local community can be there for you and support you probably is a huge uplifting part of like getting back to a good state.
Absolutely. It sure is. And it really matters. And so our thesis has always been, let's direct and connect people to the local helpers, the local organizations. And if you're living in a large metro area, it makes sense, right? If I'm in Chicago, which was where I was living when I founded SpringFour, if I'm living on the north side, I'm not going to travel all the way to the west or the south side to get assistance or vice versa. So, that's time and money, and which is people don't have. So trying to solve for that. So the way we do it is we always return local referrals first, then statewide, then national services. And we used to talk about, how many cities we had in our data, but now we really talk about how much coverage we have. And what that means is that 93% of searches within SpringFour result in a local resource first. So that shows you, hopefully, that we have nationwide coverage, and no matter where a person lives, they're 93% of the time going to receive a referral and a recommendation to an organization right in their own neighborhood. Now, we can play with the radius that we put in, and if a client wants a different radius, that's customizable, and we can do that. We can make it, spread out. And the other reason this is important is if you look at what's happened in the last year and a half, is that federal resources are shrinking. Right? Federal programs are going away. And so we've really got to make certain that people know about local resources. And I saw a lot during COVID where institutions would put up an assistance page and they would have links to national organizations. Well, that doesn't work anymore. So you really need to be first driving people to local, and then, going outwards to national.
That makes sense. And I will say, just on the fintech point in particular, like I think about brands like a Cash App or a Chime or whatever that have a really great model and a really great way of reaching into these customer bases. They obviously work with a lot of like underserved consumers, but they're not local by definition, right? Like they are like a digital only brand that doesn't have any real connections into communities. And so I could see this as a really strong way of making like what you offer as a digital brand more local and more community oriented, especially for in moments that really matter where people really need help. So it's really an intriguing way, I think, to tie digital financial services, which is kind of impersonal in some senses, to something that is deeply personal, which I think really matters. Rochelle, two last questions before I let you go. One is on metrics. And we've talked a little bit about this, but I just want to be very explicit. This shift that we're talking about does require you to think differently about metrics. And a lot of the metrics that we use in collections today are, I would say, very sort of operationally and efficiency oriented, right? So it's roll rates, it's right party contact, it's time spent on calls, number of calls made per hour, that kind of stuff. Not that operational metrics aren't important, but I think you can miss the forest for the trees if you're only optimizing for those types of metrics. So when you talk to executives who are kind of considering a shift along the lines of what we've been talking about, what are some other metrics that you think are important to measure that sort of get to this deeper sort of financial health level where you can think more about like changing the trajectory of customers' outcomes over a long period of time?
Sure. And I do think there are a lot of those additional metrics that can be really exciting. But I will say the number one is measure a reduction in your delinquencies or an increase in your repayments. Like bring it on, because we know that SpringFour will have a positive impact on those numbers and those stats. So I do want to be clear with your listeners, this is a business strategy.
Totally.
And so we understand that. And that is why we are always encouraging our clients to measure, decreases in delinquencies or increases in repayments, decrease in net credit losses, et cetera, because there will be a significant uplift for your portfolio. But the other things are looking at customer retention, looking at customer engagement. I mentioned NPS scores. Servicing and collections, very well known for not having good NPS scores. Okay. We recently had a client share that their NPS score went up 7 points because of their work with us. So those are significant increases as well. And then, servicers are very interested in recapture. Like, are they going to be able to do repeat business with their customers? So doing all of this work around financial health and giving people options is going to make that customer want to stay with you and do business with you again. And then we talked about it a little bit, but what is the impact of creating innovative strategies for collections on your collection teams and agents? It has a big impact, and that should matter. So I think all of those things combined make it, well, you would think it would make it a simple business case to say yes to doing these sort of things, but it always becomes a bit of a, long, drawn out conversation. But
totally.
And then the reporting, like, you can use all of these things to capture in your ESG reporting, your CRA reporting. This is in service of your communities and your customers.
No, and that's an important note as well. I mean, I think one of the challenges with these business cases is it's sort of like, it kind of makes everything a little bit better, right? And so it's like, will it transform any one of these metrics? Maybe, maybe not. Will it sort of be a rising tide that kind of lifts all boats and positions you better as a brand for your customers? Yes, clearly it will. The other thing I wanted to ask about is AI. Obviously, there's been a theme that's come up across all of the conversations we've had in this series so far. Yeah, you can't avoid it in 2026.
Right.
And, I think that on the surface, it might not seem particularly relevant to this conversation, but I actually think it is. I think so too, right? And I think, I guess my orientation towards it, and I'd be curious for your reaction to this, is among the many things that I think AI can do is I think it can introduce much more personalized, contextual conversations and interactions with customers, right? Where, for a long time, we've used analytics to try to do better segmentation and find little kind of segments. But there's a degree to which we can't get down to the individual using machine learning and traditional sort of analytic segmentation models, because it can't get quite that granular. I think with AI, with large language models and with agentic AI, we can start to get down to, okay, how do we want this individual interaction with a customer to go? And I would imagine that as a part of that, you are bringing in more context and you are understanding the circumstances of this individual. Hopefully you're looking at cash flow data and taking in insights into what's going on with their cash flow situation. So I would assume that AI kind of puts us on a journey towards a more one-to-one relationship and sort of set of interactions with customers. How do you view kind of financial health and financial hardship assistance and some of these things fitting into where AI is taking us?
I think it's super exciting. So the bottom line is, right now, not many lenders are doing a great job with financial health and helping their customers with payment hardships, right? So if we can train the AI and the chatbots and the agentic AI agents to be better at this, I think we're going to see really great results. We're going to see efficiency. So you're going to be able to see customers' situation be resolved in a much quicker and efficient way. And how we're approaching it is, we are, in a way, the large language model for financial health referrals, right? So we have the data and we have it in a closed environment, and it's secure and it's trustworthy. So what we want to see happen is a bank's AI agent pulls from the SpringFour database to be able to deliver in real time referrals to whatever financial hardship that person is facing. And then you can have that AI agent it could be a simple direction to the consumer self portal, or it could be the next iteration would be really hearing what Alex has to say, asking Alex questions, because we've helped train with very important prompts that will then reveal to Alex, ABC food pantry that's 1 mile from your home. So in this case, I don't think the AI is that complicated if you're getting the data from a secure source, right? You don't want your AI agent to go out and basically, ask a large language model about a food pantry and it returns Well, that's not a good example, but let's say financial counseling, and it refers somebody to an unscrupulous financial counseling agency, which there are plenty of those out there. But that's why you want to train your AI agent to utilize trusted information and data such as SpringFour. So we're working on it right now. And then also you can have your AI agent go in and quickly read any customer notes and then be able to do recommendations.
Totally. Yeah, no, it seems like it'll be helpful sort of across the board, but I'm glad you called out the trusted data, because that's the thing you worry about, right?
That's the key. Yeah.
Yeah.
With us, you can't hallucinate, right? It's going to pull from but I still think we're a long ways off from adoption by the FIs.
Yeah, no, I think so too. I mean, all the stuff we've been talking about in this series is all like directionally where we're going, but there's a lot of work to do between here and there. And Rochelle, I will let you get back to that work. Thank you for carving out a few minutes for me. As always, it's a delight to talk to you. It was a delight to actually get to record this conversation. Thank you very much.
Thank you so much.
This episode is brought to you by CNR Software. More than just debt collection, CNR sets the global standard for AI-native, humanized credit management. They simplify the complex with end-to-end credit risk lifecycle support, powered by automated workflows, AI-native intelligence, and real-time data-driven decisioning. Learn more at crsoftware.com.